Now, the troubles coming out of Dubai in the last week, highlighting the risk that's linked to some segments of the bond market. Justin McCarthy is head of research at FIIG Securities. He's in our Brisbane newsroom for you. Justin, warm welcome to trading day. The bond market this week seems to have kind of shaken off these Dubai concerns fairly markedly. Just how do you read that?
That's exactly right. The Dubai world situation arose around this time last week, and it put a cat amongst the pigeons, or was a big scare in the bond markets. But as the news progressed during the week, and particularly earlier this week, the losses expected were much lower, and the market has just really treated it as a blip. We really think that the market has probably undersold this. We think it is a good sign, or a good reminder, that there's plenty of risk out there.
And yet, Justin, it has highlighted, even sovereign wealth funds that were perceived as being as safe as houses, with an implicit government bulwark against any default, are not as safe as houses any longer. What does it do to the likes of the Temaseks of this world out there?
That's exactly right. Some of the big sovereign wealth funds, like those ones in Singapore, we still think are pretty well protected, but it's probably a bigger impact across a lot of what they call quasi-sovereigns, or entities, particularly in Asia, that are wholly owned or substantially owned by the governments, but don't have an explicit guarantee, just have this implicit guarantee, or a handshake, or even other cases, investors are just reading in that they expect support. So what we've really seen is the risk premium that investors are requiring for those types of arrangements has really increased.
Is it going to be, therefore, though, the death knell to implicit guarantees, or just you pay a premium when you're in that sort of so-called non-sweet spot?
I think it's just a good reminder that the age-old rules of lending and investing. Really know what you're investing to, know what you're investing in, know the terms, and if you're going to be relying on an implicit guarantee or a handshake, if you will, you really want to make sure that there's a history of support in very tough times, not just a hope that if things get bad that someone will stand behind it. And as you pointed out, I think that the main impact is really a reassessment of the risk premiums that are required for those that are implicitly guaranteed as opposed to explicit.
Let's just talk, if we can, as well, about the rate rise that we've seen from Westpac today. I've been looking at the email, expecting a drop from one of the other big four. It hasn't come yet, and people have said if it doesn't come by Saturday, or if it comes on Friday, it'll be written about in an embarrassing way all through the weekend press. How do you read where consumers are now kind of sitting? Are they better or worse off? Because, they've also got that deposit facility to look to.
That's exactly right. There's no two ways about it. I think mortgage holders are going to see further increases, in this increase of 45 basis points against the 25 basis point RBA rate. It's no surprise really to us, because we've really seen, particularly in the deposit market, the cost of funding has really increased. And for example, if you go back prior to the crisis, deposits for, say, 1 year's maturity, Westpac and the other banks were able to raise at maybe a margin flat to what we call the swap curve, or BBSW. That might now be as high as 1%, and we're even seeing some special rates as high as 2% above. So while it's not good news for mortgage holders, there is a silver lining for investors, retail and wholesale alike.
And this is unavoidable. You would argue that there's no alternative means of getting that funding, another bond issuance, another capital raising?
There are different avenues, but what we're really seeing is a change in the mix of funding for the banks. The importance of deposits has definitely increased, and also it's a mix in the length of maturity that their funding is taking. What they're tending to have to do, and in part by APRA requirements, which are going to come in early next year, is to really lengthen those maturities. So we really don't think there is any alternative, and I think that Westpac's argument that their cost of funding is increased is very valid.
Justin, really briefly, finally, hybrids. Can we just move into that space? The yields, current yields that are on offer, we must just focus in on that if we could.
Yeah, that's exactly right. The two spots that investors are best to look at right at the moment are at the top end of the capital structure, which is in the term deposits, and as we sort of mentioned, we can see some rates as high as 6.8% for 1 year, even a bit higher through the broker networks. And then right down the bottom of the capital structure, above the equities, is the hybrids. And again, using Westpac as an example, we're seeing yields in some of the hybrid, so the Westpac Trust, as high as 10.5%, even 11% earlier this week. So there's some pretty high returns you can get from investing with some of the major banks in this country.
We must leave it there. We do appreciate it, Justin McCarthy. Many thanks.
Thank you.
Head of Research at FIIG Securities there in Brisbane.